Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 1 of what is going to be at least a 4-part video series on tax-efficient charitable giving, also known as making charitable donations or charitable contributions. In this video series, we're going to take a deep dive into the following 5 topics related to tax-efficient charitable giving, including number 1, how charitable giving may be used to reduce your RMDs, and number 2, how charitable giving fits into our Roth IRA conversion and overall tax planning strategies, including how all of this works in conjunction with our personal tax planning template. So topic number 1, we're going to set the stage for charitable giving by taking a detailed look at Schedule A itemized deductions. A solid understanding of Schedule A really helps to solidify the concepts behind the tax benefits related to charitable giving. Topic number 2, we're going to build out some detailed examples of charitable bunching, so we can examine how this strategy both, number 1, provides enhanced tax benefits related to charitable giving, and number 2, lays the foundation for use of donor-advised funds, also known as DAFs or giving accounts. Then in topic number 3, we are going to cover number 1, how a donor-advised fund or giving account works. Number 2, how you can easily set one up. Number 3, how you can name it, something like the ABC Family Giving Foundation. And then generally how the DAF can be used to satisfy both your giving objectives as well as your tax planning goals. Then in topic number 4, we're going to look at QCDs, i.e. qualified charitable distributions from our traditional IRAs, and how this type of charitable giving can help us 1, satisfy our RMD requirements, 2, how QCDs interact with our Roth IRA conversion planning, and 3, how QCDs can potentially be used to reduce the taxability of our Social Security in certain income situations. Then in topic number 5, we're going to examine the double tax benefit of donating appreciated stock and other securities instead of cash. And then we will do a summary of how donor-advised funds, QCDs, and donating appreciated stock interplay with each other. We will also answer the question, can I contribute traditional IRA assets to a donor-advised fund? And of course, we will incorporate everything from our charitable giving discussion into the personal tax planning template, so you can determine the best strategy for your situation with respect to getting the most tax efficiency out of your charitable giving. With that said, let's jump in. And by the way, if you enjoy this video, please like and subscribe, and let me know in the comments what's going on in your personal tax planning situation. Alright, to make the tax concepts surrounding charitable giving, QCDs, bunching, and donor-advised funds, aka giving accounts, crystal clear, we first have to understand itemized deductions on Schedule A. So right here I have a little comparison of itemized deductions versus the standard deduction. Now about 20% of Americans currently itemize deductions, and about 80% of Americans currently take the standard deduction. You don't have to quote me on this exact percentage right here, but this is roughly what it is based on my personal experience. Now there are 4 categories of itemized deductions, and we're going to go over the main 3 categories of itemized deductions right here. So the first category is going to be home mortgage interest, and for your average American, you're typically going to see somewhere between like $5,000 and $20,000 on the tax return. I'm not saying it can't be more than this if you have a big house with a big mortgage, but on average, this is what you see. The second category is going to be your state and local taxes, and this is capped at $10,000 under the Tax Cuts and Jobs Act. In fact, it's this cap that was put in place under the Tax Cuts and Jobs Act that caused more and more people to stop itemizing, because this cap was enough to basically kick them out of being able to itemize and push them back into the standard deduction. And then the third main category is going to be your charitable donations, and you're going to see a wide range here. This could be anything from a few $100s up to 6 figures. It just depends on each person's financial situation situation and their giving goals. Okay, now generally you will need some level of charitable giving in order to itemize, and this is especially true for married filing joint. Now, why is that? Well, here's the answer. Let's do a little bit of rough math. So if we go back over here to our typical numbers for your average American, $5,000 to $20,000 of mortgage interest, plus let's say up to $10,000, which again is the cap for state and local taxes under Tax Cuts and Jobs Act, then rough math over here would tell us that your typical married couple is going to have somewhere between $15,000 and $30,000 of deductions specifically related to these two items right here. And so when you look at this range of $15,000 up to $30,000 and you compare it to the standard deduction, which for 2024 is going to be $29,200 for married filing joint, what is the likelihood, if you're in this range right here, what is the likelihood that you're going to be above this number right here? And the answer is pretty low. You would really have to be right at the tippy top of this range in order to be above this amount just on these two alone. So if you only have these, generally you're not going to be itemizing for married filing joint. Now on the other hand, for a single filer, when you look at this range right here and then you compare that to the standard deduction right there, it is certainly much more common that you could be above the amount for the standard deduction just on these two items right here. And when you think about it, whether you're talking about a single filer or a couple that's married filing joint, home mortgage interest and your state and local taxes, most of that is going to be property taxes on your personal residence, by the way. These numbers don't fluctuate that much between a person who lives alone and then a couple that lives in an equivalent house. Like you could have a few dozen houses all on the same block with all roughly the same mortgage interest and property taxes on it. Some of them have one person living there, some of them have two people living there. It doesn't actually change the mortgage interest or property tax very much, if at all. So that's the reason why you may see single filers actually itemizing based on these two, but very rarely married filing joint. If you're married filing joint, you're probably going to need some charitable donations in order to itemize. And that's not to say that you should be making charitable donations just for the purposes of itemizing. The point is that if you're not making charitable donations for married filing joint, chances are you won't be itemizing. Now let's talk about what do you really get, quote unquote, from itemizing deductions. So example number one, assume that your only itemized deduction for 2024 was charitable donations of $29,200. Assume your filing status is married filing joint. What did you get, quote unquote? And the answer, strictly from a tax perspective, is that you got nothing. You got no tax benefit from those itemized deductions, i.e. no tax benefit from your charitable giving, because you would have gotten $29,200 of standard deduction anyway. And that's the premise that we're going to use to kick off the entire conversation about charitable giving. You don't get a tax benefit for doing something if you would have already gotten the same tax benefit for doing nothing. In other words, in this example, you don't get tax benefit for donating $29,200 to charity if you would have gotten $29,200 of tax benefit anyway in the form of the standard deduction. That is the basis for all of the other strategies that we're about to talk about, is you don't get something for doing something if you would have gotten it anyway. Now let's do two quick clarifications before continuing. Clarification number one, when I say a tax benefit, that means a reduction to taxable income across the board. That's going to be the same for everybody. How much of a reduction there is to the tax you actually pay will vary depending on your marginal rate. It'll vary depending on the kinds of income you have, like if you have Social Security, for example. What ultimately goes into the amount of tax you paid calculation calculation is going to have a lot of moving parts and variables, and tax benefit can also mean that as well, but we're going to use it to generally mean a reduction to taxable income, which is going to be consistent for everybody. And then clarification number 2, just in case this is not obvious already, for the remainder of this video, in fact, for the remainder of this entire video series, when I say that you got benefit or did not get benefit from charitable giving, I'm strictly talking about the tax benefits here. Your receipt of intangible religious benefits or personal benefits caused by the act of giving is a completely separate thing. This entire video series is premised on the idea that you want to engage in charitable giving for these kinds of benefits right here. As I mentioned a few moments ago, I would never suggest engaging in charitable giving strictly for the tax benefits. People engage in charitable giving for these reasons. What we're talking about in this video series is if you are doing this anyway, then how can we maximize the tax benefits from what you're doing as far as charitable giving? Okay, example number 2. Assume married filing joint and also assume that your itemized deductions, we're going to do the 2023 tax year, were as follows. $13,700 in mortgage interest, $10,000 in state and local taxes, $10,000 in charitable donations. So the grand total of these 3 items right here is going to be $33,700. What tax benefit did you get from your charitable giving in this example? Well, the answer to that question is right here. So we have total itemized deductions of $33,700. The standard deduction for married filing joint for 2023 was $27,700, resulting in a tax benefit from your charitable giving of $6,000. So in this example, you missed out on getting any benefit from $4,000 of your charitable giving. In other words, you gave $10,000 here, but your actual tax benefit only ended up being $6,000 of the total $10,000. Now multiply that by 10 years and you've donated $40,000 without getting any tax benefit for it. So now let's go to TurboTax and make sure we understand how we're only getting $6,000 of tax benefit from the $10,000 of charitable giving above. Okay, let's look at these 2 examples side by side, and the first thing I want you to notice is that adjusted gross income, or AGI, is the same in both examples. So we have $153,496 right there, and we have $153,496 on this side as well. Now, on the left side, we're going to take the standard deduction of $27,700. Again, this is a 2023 tax return. And on the right side over here, we're going to take $33,700 in itemized deductions. This will result in $125,796 of taxable income on this side, and we're going to have $119,796 of taxable income on this side. All right, so now let's follow this arrow over here to Schedule A so we can see what the details are that make up this $33,700. So here's our Schedule A right here. As you know, this is our itemized deduction schedule. Now earlier I said there were 4 kinds of itemized deductions. We've only talked about 3 of them so far. Here's the 4th one right here, medical and dental expenses. Now what I want you to be aware of with respect to this item right here is that medical and dental has its own separate threshold, separate from everything else on the itemized deduction schedule. And the threshold is right here, 7.5% of this number right here, and this number is our AGI, which we just looked at over here a few moments ago, $153,496. So on this schedule, we take the AGI, we multiply it by the 7.5%, and we get this threshold. In this case, it's $11,512. Now, I don't have any medical or dental in this tax return right now. I just have it at 0, but what I want you to notice is that in order to get any number to show up right here as an itemized deduction, which you can take on your tax return, the amount of medical and dental that you have on this line has to be more than this number. And for this reason, most people, even when they itemize, almost nobody ever gets any medical for federal purposes. You might be able to get a little for state purposes. That kind of varies on a state-by-state basis. But for federal purposes, very few people ever get a number to show up right here. You have to have a pretty large amount of medical expenses, more than the average couple tends to have, or more than the average person tends to have, I should say. And that's why we're basically leaving this one out of the analysis. Out of like 400 tax returns that I've seen in the last year, let's say, I can only recall one that had a number showing up right here. So this is very uncommon to actually get any medical. I always say you kind of have to have buku medical in order to get a deduction for it. So we're gonna leave this one out and we're just gonna focus on the other three. All right, so the next item on the list is gonna be your taxes paid. Again, this is primarily going to be property taxes on your personal residence for most people. In this case, I'm just gonna max it out at $10,000. If this number happened to be more, like you put $15,000 in here, TurboTax or any tax software will limit the amount of the deduction to $10,000 right here, because that's the maximum amount under current law, under the Tax Cuts and Jobs Act, that you're allowed to take. Then the next item is going to be interest you paid, and again, this generally means mortgage interest and points. So in this case, I have the $13,700. Then if I go over to the next screen here, this is all the same form. This form right here and this form right here are the same thing. This is just further down on the screen, so I had to snap a separate picture of it. So the next item in the list is our charitable giving, and we had $10,000 in our example, leading to total itemized deductions, as we mentioned earlier, of $33,700, and that's how the number gets back right over here on the face of the 1040. So in this fact pattern, let's say that over on this side, all we had was the mortgage interest of $13,700 plus the state and local taxes of $10,000. So that would be $23,700, which is less than the standard deduction of $27,700, and so we did not itemize deductions over here. Then let's say that in addition to the mortgage interest and the state and local taxes, we went out of pocket $10,000 in charitable contributions. As a result of that, our taxable income went from $125,796 right here down to $119,796 right here, a reduction of $6,000. And so just like we said before, when we put these numbers in TurboTax, going out of pocket $10,000 in charitable contributions in this fact pattern leads only to a tax benefit of $6,000 in the form of reduced taxable income. Let's do a couple of concept checks before we move to the next section. So concept check number one, you only get benefit, and this is by tax year, for the amount by which your itemized deductions exceed the standard deduction. So in our example, we had $33,700 of itemized deductions, which was in excess of the standard deduction of $27,700 by $6,000. So the tax benefit we received by itemizing was $6,000, not $33,700. You can't get benefit for something that you would have received anyway. Concept check number two, even more importantly, you lose benefit for the amount of itemized deductions that it takes to reach the standard deduction threshold. So in our example, we had $23,700 of mortgage interest and property taxes, and it took $4,000 of charitable contributions just to reach the standard deduction threshold of $27,700. So we lost benefit for that $4,000 that it took to reach this threshold. So when it comes to tax efficient charitable giving, the question becomes, how can we structure our charitable giving to maximize the tax benefit we receive and not lose benefit in the way just described above? And the first step in that process is to understand the concept of charitable bunching. And that's where we will pick up in video 2 of this charitable giving video series.